Welcome back to Your Average Investor. Today we're going to be talking about AMC. Why are we talking about AMC? Well, they report earnings in about 5 minutes. And what a wild ride it has been for AMC investors over the last few years. If you haven't heard, your head's probably been under a rock, or you've just never invested before. Either way, it's fine. We're going to catch you up to speed. 2020 meme stock mania kicked off with GameStop, AMC, as well as a few others like Bed Bath & Beyond, and I don't know, maybe one or two others like BlackBerry or something, rapidly increasing in price due to massive short interest that was noticed by investors like Michael Burry, as well as Roaring Kitty, and then by the larger Wall Street bets community, as well as others, and it caused a massive surge in price. Now, this is post reverse stock split. AMC did a 1 for 10 reverse stock split, so if you were following along at the time, AMC was trading at about $2 a share, jumped quickly to $20 a share before basing for a bit of it, and then going all the way up to $72 a share. Again, after the post-stock split, it now reflects as about $20 up to $200, and then all the way up to $720 a share. Before, just like GameStop, moving back down, down, down. The big difference, though, is unlike GameStop, which seems to have maybe found a base, and it's actually still a little bit above where it was pre-meme stock mania. AMC hasn't been able to catch a break at all. In fact, from all-time highs, it's down about 99.999%. But even if you just zoom in here to the last several months, down from $50 a share post-stock split, again, $50 a share, reverse stock split, to $3 a share with an all-time low of 2.38. Now, if you do the math on this and pretend like the stock split never happened, this is equivalent to 24 cents a share or 32 cents a share as it stands right now. So imagine you were buying back meme stock mania at like $2 a share, and you're thinking, yeah, this is a great price to get AMC. It's $2 a share. Well, now you could be getting it at 24 to 32 cents per share. Again, this is reverse stock split though, so now it's showing up as $2.38 at the low and $3.18, $3.17 right now. If we're looking at this from a technical analysis, I mean, there's really no way to trade this technically, right? Like, nothing makes sense back here. You don't have any way to get anything here. If you zoom in to cut all that out, all you have is just this slow, slow, slow decline. There's no bases that seem to be forming that can't be broken. Maybe you can say, oh, this is like if I was really zoom in here, we've got a higher low right here as compared to here. But, even that you can't really say is much of anything. So that begs the question, what the heck is going on with AMC, and why would it be trading at literally a 90% discount, not to where it was here, but to where it was here right before meme stock mania? It's a 90% discount to that. Well, let's take a quick look at FinViz so you can get a little overview here. Currently, there is an 18% reported short float, depending on who you talk to about naked shorting and ghost shorting and dark pools and all that kind of stuff. They might say, oh no, the short float's much larger than that. But the fact remains the reported short float is 18.4%. There may be more, there may be less. Who knows? That's what's reported. So we've got an 18% short float. You've got $3.30 cash per share, and you say, oh, that sounds pretty good. That means if I buy right now, what's the price right now? Let's just go here, $3.17 per share. I'm basically buying $3.30 worth of cash, except for AMC is still losing money. And so their book value per share is negative $7.09 per share. You can see that reflected here. They have sales of $4.81 billion and income of negative $324.6 million. So they are losing money every quarter, and because of that, their cash per share they're raising cash. What they've been doing for a while is they've been selling shares to raise cash and using that cash to finance operations. And this actually brings back the larger philosophical conversation around shorting stocks by hedge funds to force them into bankruptcy, because this is not an uncommon practice for public stocks to make a secondary offering on the stock market or a primary offering and sell shares that the company owns in order to raise funds to expand operations, cover expenses, do whatever they need to do. But they can only do that if people actually will buy the shares, and if they can remain listed on the stock exchange. And I believe the New York Stock Exchange has ruled that you have to be above $1 per share or something like that to stay listed. And so that's why it forces companies to do these things like reverse stock splits in order to remain listed, not get delisted. And AMC has been going through the ringer with that. Now, beyond just raising money, let's talk about a little bit with like what is it that they actually do, and why why are they so expensive to run? Do you think with so much income they'd be able to run a profitable business? The big problem is their massive amount of debt. They have I don't know where it went here. Total liabilities, $10 billion. $10 billion in liabilities, $9 billion in debt. A lot of that is on leases for properties with high interest rates at this point. And so even with everything else, with all of their earnings and revenue and all the money that they show that they're making, it's become very difficult for them to operate at a profit. You could say that that's okay because, you know, if you look at their revenue growth rate, here's 2021, and this is in millions. So when you see 2,500 here, that means 2,500,000,000, 2.5 billion. 2022, almost 4 billion. 2023, 4.8 billion. So they are growing revenues. And if you look at their operating costs and expenses, we're going to, let's just look right, where's total? Total expenses, I don't know where it went. Anyway, we'll just look at this top line here. You can say general operating expense. Here we have, you know, 1.1 billion, 1.5 billion, almost 1.7 billion dollars. So their operating expenses are growing as well, but it looks like they're growing their revenues at a faster rate than their operating expenses, which is good. They're just still losing money, which is not good. And so the question becomes, can they turn it around and start making money before they run out of money and run out of the ability to continue to sell shares on the secondary market? So let's pop over now and look at what's happening with their looks like maybe it has not started yet. I thought that it started their webcast right at 5 p.m., which is right now. No, it's not. It's 4 p.m. Ha! I'm going to have to cut this video and tune back in an hour. All right. We are back. It looks like some preliminary information is being released with the AMC earnings. There was just a recent spike from 3.16 all the way up to 3.34, which doesn't sound like a whole lot, because it's not, but it is a couple percentage points for a $3 stock. So let's see what's going on in the news section over here. Here we go. AMC Holdings sales 951.4 million, beat the 8.71 million estimate. That's a pretty good beat. They beat by $80 million. So I'd say that's something to be excited about if you are an AMC investor, which, full disclosure, I had forgotten about this, but I don't use my Robinhood account anymore. But a while back I had bought 100 shares of AMC just for the YOLO of it. And so I am an AMC investor, full disclosure here. All right. Now let's take a look at what is coming out next. AMC reports, blah, blah, blah. They've been posted to investor relations. Okay, let's see it. Let's go back to the investor relations and refresh this, see if we can get the webcast going. There we go. Earnings release PDF. Let's take a look. Okay. Total revenues, 9.5 milli. Net loss. Hang on, let me just quit these. There we go. Improved, but it was still a net loss. That's kind of spooky, right? They still lost 160 million compared to Q1 of last year, which was a loss of 235 million. So it is narrowed. Net loss per share, 62 cents compared to 1.71. Adjusted EBITDA. Okay, net cash used in operating activities was negative 188 million, which is about the same as last year. Cash and cash equivalents, they've got a 624 million war chest. Kind of interesting. They're losing right now 163 million per quarter, and they have a war chest of about $600 million. Do some quick math there. That means they have roughly 1 year. If nothing else changes, they've got 1 year's runway before they're out of cash and have to raise cash again, either through selling shares and diluting investors or some other means. And of course, ideally, you'd say, well, this is great because they're improving year over year, and so quarter over quarter, likely they'll improve as well. And let's just take a look here. So there's revenues compared to, as what we just read above. All right. Anything else exciting? The company will host a webcast. Forward-looking statements, blah, blah, blah. Okay. All right, let's break down the revenues. Admissions, $530 million compared to $534 million same quarter last year. So that's not great. I'm thinking if they're a movie theater chain, I know they're trying to expand into other stuff. But they're a movie theater chain, and admissions are flat or a little bit down year over year. Food and beverage sales down year over year, 321 compared to 328. Other theater, I don't know what other theater is, but that's a little bit better. That's 99 instead of 91. So there's actually about an 8%, 9% improve, or maybe a 10% improvement there. So that's encouraging, and that makes up for part of the loss up here. Total revenues 951 compared to 954 of the same quarter 2023. Operating costs. Film costs, that's about the same, little lower in operating costs there. Food and beverage, a little higher. That's interesting. So they had higher food and beverage costs, but lower food and beverage revenues. Rent, operating expense, let's go rent. Okay, so rent, 205 million. Now their rent is 224 million. That's a little bit, that's pretty high. That's gonna stay that way or even get higher most likely. Depreciation, amortization, operating loss. Okay, nothing else really there. Cash equivalents. So yeah, I mean you can see here, right? The cash equivalents basically just went down by what they lost, 160 million. Corporate borrowings, $4.5 billion. Financial lease liabilities. So their total assets, $8.5 billion, down from $9 billion. December 31st, 2023. Okay. Number of screens down by a couple hundred. Number of theaters operated, number of screens operated. Yeah, so they have less theaters now. Interesting. But their attendance is also down. Huh. All right, let's look at this. U.S. markets. Ticket price. Average ticket price has gone up by about 25 cents or so. 35 cents. This is interesting, though. So internationally, they did a little bit better. U.S. market was down, but international, they did better. Anything else important here? That's about it. Well, let's look and see what the stock price is doing now. Look at that. Boom, up, and then straight back down. The market is not liking what they're hearing. The market makers, the hedge funds, the hedgies, the bad guys. Retail investors would never sell AMC. Sarcasm. Interesting. See, here's the thing. I personally think that it's wild that AMC is trading at its current price compared to where it was a couple years ago. In my mind, it's like, all right, they're not that much worse off, if at all, than a couple years ago. Maybe they're even better off, but They're trading at a 90% discount to it. And basically what's happening here what's being priced in is, I think people are thinking they're going to blow up because of their debt. So they've got so much debt and so much that's due in rent every month for their theaters that any type of hiccup and they just totally blow up. They can't do anything, and they have to file for bankruptcy. And what's kind of crazy about that is, like, look at Hertz, right? What's that, HTZ or something like that? Hertz, this is one of the most wild things ever. Yeah, here's Hertz. Look at this. So Hertz, they went bankrupt, and then were delisted, and then relisted IPO, and then just went nuts, and now they've sold, right? Like, look at this. This is like, how is this not just dumping your shares on investors trying to desperately raise money? They went, did their IPO, big old spike up to $46, and just sell off down to back to $4 a share now. Like, are they just going to bankrupt again? Rinse and repeat. Another one that I saw happen with this recently, was it NCMI, National Sin Media? These guys were trading at right here, like $1 per share. Let me go back to the yearly chart. $1 per share. They announced that they were going to file for bankruptcy, and actually they did a 10 for 1 or something. What was this? Yeah, 1 for 10 reverse stock split. So it was like 10 cents per share. Boom, up to like 60 cents per share after they announced that they were going to file for bankruptcy. Literally increase of 500%, and they've maintained that since then. And of course, part of the reasoning behind that is through bankruptcy, the lender doesn't want to lose everything, and so sometimes they will let the person write off some debt and negotiate better terms. So maybe that's something that AMC hasn't up their sleeve. They could always try to negotiate for better terms. Say, hey, we owe you $9 billion. That's not something that you want to just see go poof. And so maybe they could negotiate for better terms there. But I mean, look at this. Spike up, right back down. There's nothing really going on here. Let's see what other news highlights have come. So they beat the estimate. Continue to be affected by the Hollywood strikes. Blah, blah, blah. Nobody cares about that. Confident in ongoing recovery trajectory with more films slated. Here's something that's kind of wild. I used to be a big moviegoer. My wife and I both. And we never go to the movies anymore. Like, it's just become so dull to go to the movies. I don't know. Like, there's no movie coming out that I can think of that I'm excited about. This is interesting. Their their mini pivot into working with, I guess, music stars. So they had like their Taylor Swift and their Beyonce thing, and they're doing a Billie Eilish thing, where they're basically showing on the big screen like a video of a concert or something like that. And what I like about this method is it's bringing foot traffic into the theater that might not otherwise go, right? Like, it used to be people got way excited about the new Star Wars show or the new Marvel movie or something like that. And now it seems like people don't really care about that anymore. Maybe they got burned out. Or maybe it's just that the movie tickets are too expensive now. I remember tickets used to be like $7. Now they're $12. So if me and my wife want to go on a date night, get movie tickets, we're going to be paying $30 for movie tickets. And then with food on top of that, if we want to like eat out, then it's going to be like $30 to eat out at like a fast casual. And that's pretty middle. Like there's fast casual, you'd be spending more than $15 a person. But so we're looking at $60 for dinner and a movie, which, I mean, I don't want to spend $60 on dinner and a movie. Just go get Netflix, make something. I make great food. She makes great food. We'll just make some stuff at home. But the interesting thing is, so you're basically what you do is you're piggybacking, you're trend jacking off of these big names like Beyonce, Taylor Swift, Billie Eilish, and getting all of their fans to come out and visit your theater. And then of course that drives more sales of your food and beverages and things like that, and possibly gets people excited about going to see a movie again, because while they're there they go, oh, look at this movie poster for Willy Wonka and the Chocolate Factory or whatever's coming out next, and maybe they think I'll go back and do that. So I don't know, it's okay. If it were me, so again, I already own 100 shares that I'm down like more than 50% on. If I didn't already own 100 shares, I wouldn't buy any shares here because I don't like AMC as a stock long term. Not that I think they're not going to make it. I just don't think that they're. I like investing in companies that are like really changing the future or have really secure income for me. So like that dividend video that we put out a little bit ago, right? I love investing in nice dividend companies. I love investing in nice tech companies that are really changing the world. And I don't see AMC fitting into either of those. Did they ever pay a dividend? They did. So they used to pay a dividend, right? And that would be cool if they reinstated their dividend, which they're not going to do because they're operating at a loss right now, and it would be idiotic of them to reinstate a dividend while they have basically a year runway, assuming they don't improve any more than they have. However, if I'm thinking of this from like a value investor standpoint, if AMC next quarter showed that they were continuing to narrow their operating loss, or if they got a surprise and they were actually operating profitably, at that point I might consider throwing some money in. Until then, though, they got a lot of debt. They are increasing their revenues, but it doesn't look like they're on a track rate to increase them fast enough to be profitable within a year, which means they're going to be selling more shares, which will dilute current shareholders and continue to drive the price of AMC down. So that's my current thoughts on it. And I know that's probably going to get a lot of hate from the AMC ape crowd that loves it. And I agree with I agree with a lot of what they stand for, which is corrupt hedge funds and others need to get out of shorting stocks into bankruptcy. I think that's totally valid. I just there's a lot of claims that they make that are difficult to substantiate, and so all I'm doing is just going off what can I actually see, right? There's an 18% short interest in the company. 18% of the float is sold short. I can see the financials right here in front of me that they just published. They're still operating at a loss. They've got, so there's 160 million loss. They've got about $600 million cash on hand, right? So that's look at this. You just go 600 million divided by 160. So they've got almost 4 quarters left of cash left. That's about what they've got, is 4 quarters, a year's worth left of cash. And we'll see what happens. But that's it for today. Thanks for tuning in. Please subscribe if you haven't already, and we'll catch you next time.